It is Monday, December 1, 2025, and right now as we look at the live market tape, CleanSpark Inc., ticker symbol CLSK, is trading at approximately $14.12 per share. The stock is facing significant intraday pressure, currently down about 6.49% to 6.62%, depending on the exact second you check the tick. If you are watching the charts, you are seeing a distinct red candle forming on the daily, pushing the price down from an open of around $14.17. The volume is heavy, already crossing 23 million shares, indicating that this isn't just a quiet drift downward, but a battleground where significant hands are exchanging paper. This price action creates an immediate jarring disconnect for anyone who just glanced at their recent headlines. If you only read the earnings report from a few days ago, you would expect this stock to be tearing through the ceiling, not struggling to hold the $14 level. This brings us directly to the tension between expectation and reality that is defining CleanSpark's current moment. The expectation, held by many retail investors and casual observers, was that CleanSpark's blowout fiscal year 2025 earnings, where they beat EPS forecasts by over 300% and doubled their revenue, would act as immediate rocket fuel. The narrative was simple. They are mining more Bitcoin than ever. They are efficient and they are profitable. However, the reality is far more nuanced and, frankly, heavier. The market is not reacting to the past quarter's success, it is reacting to the massive capital maneuvers the company is making to secure its future. The drop we are seeing today is largely a hangover from the announcement of an upsized $1.15 billion convertible note offering. While this secures capital for expansion, it triggers a primal fear in the market regarding dilution. Investors are currently weighing the immediate pain of potential share dilution against the long-term reality that CleanSpark is attempting to transform from a mere Bitcoin miner into a massive energy and AI infrastructure colossus. To understand why the stock is down nearly 7% today despite a perfect operational backdrop, we have to look closely at the mechanics of what has happened over the last week. The company reported revenue of $766.3 million for the fiscal year, a staggering 102% increase year over year. They posted earnings per share of $1.12, crushing the analyst consensus of 28 cents. In a vacuum, Apple stock or Tesla stock posting a beat of that magnitude would likely trigger a massive rally, but CleanSpark is operating in a sector that is currently fighting two headwinds: a correction in the price of Bitcoin itself, which dropped roughly 30% in November, and the company's own decision to raise cash aggressively. When a company announces a billion-dollar convertible note offering, sophisticated traders using platforms like Interactive Brokers often short the stock to hedge the convertible arbitrage, creating immediate selling pressure. This is a technical dynamic that often confuses retail investors who use the Robinhood app or SoFi Invest interfaces, who see the good news and cannot understand why the chart is bleeding. The trading volume we are seeing today suggests that the market is still digesting this capital raise. Institutional investors are reshuffling their models. They are calculating whether the cash raised, which is effectively at 0% interest, will generate enough return on investment to offset the fact that there are now more potential shares in the ecosystem. It is a classic short-term pain for long-term gain scenario, but the market is notoriously impatient. Furthermore, we have to talk about the broader crypto mining sector context. Bitcoin recently dipped toward the $82,000 level after peaking much higher, and that 31% correction in the underlying asset is acting as a gravity well for all miners. You cannot decouple CLSK entirely from BTC price action, even if their operational efficiency is superior. When Bitcoin sneezes, miners often catch a cold, and today's red tape is a symptom of that broader asset class volatility. However, there is a counter-narrative building in the background that you might miss if you only look at today's percentage drop. Just days ago, JP Morgan upgraded CleanSpark to an overweight rating. This is significant. Large institutional desks, the kind that handle Fidelity Wealth Management or Fidelity brokerage accounts for high-net-worth clients, pay attention when a major bank explicitly validates a miner's strategy. The upgrade wasn't just about Bitcoin, it was about the AI pivot. CleanSpark is actively engaged in repurposing its massive power capacity for high-performance computing. In a world where NVIDIA stock has set the tone for an AI-driven market, energy is the new gold. CleanSpark controls over 1 gigawatt of power. By positioning themselves as a power provider for AI data centers, they are effectively hedging against crypto winter. This is the reality that the smart money is trying to price in, even while the stock sells off on dilution fears. Let's take a step back and look at the actual trading mechanics available to you. If you are sitting there with your Schwab Intelligent portfolios or looking at your dashboard on Fidelity Investments, you might be wondering if this dip is a buying opportunity or a falling knife. The difference often comes down to your time horizon and your tool set. Active traders using interactive brokers trading platforms are likely scalping the volatility, looking at the support levels around $13.50 and $14. Meanwhile, passive investors using investing sites or Fidelity mutual funds might be looking at this as a sector rotation play. The barriers to entry have never been lower. You can buy Robinhood fractional shares of CleanSpark for a few dollars. But the complexity of analyzing a miner that is becoming a data center landlord is high. It requires looking beyond the daily candle and understanding the balance sheet. Speaking of the balance sheet, the company also completed a $460 million share buyback recently. This is a crucial detail that often gets buried. While they are issuing notes that could dilute shares, they are simultaneously buying back stock, which neutralizes some of that dilution impact. It is a sophisticated financial engineering move designed to keep the share price stable while raising massive amounts of cash for infrastructure. It signals that management believes the stock is undervalued at these levels. When a company buys its own dip, it is usually a signal worth watching. It suggests that the reality inside the boardroom is far more bullish than the expectation of fear dominating the public forums today. Now, we need to address the business model briefly to ground this analysis. CleanSpark defines itself as America's Bitcoin miner, but that label is becoming insufficient. At its core, CleanSpark is an energy infrastructure company. They identify undervalued energy assets, transformers, substations, land with power contracts, and they build data centers on top of them. Historically, they filled these data centers with Bitcoin mining, ASICs. The business model is simple. Pay a fixed low rate for electricity and use it to mine Bitcoin, which can be sold at a variable, hopefully high price. They are famous for their proprietary software, Stratos, which automates energy usage to maximize margins. However, the new leg of the stool is the AI infrastructure. They are building sites in places like Sandersville, Georgia, and acquiring capacity in Texas, not just for mining, but to lease rack space to AI companies. This transitions them from a pure commodity producer, Bitcoin, to a real estate landlord for the digital age, commanding stable, long-term leases that are less volatile than crypto prices. The shift into AI is where the comparison to NVIDIA stock becomes relevant again. NVIDIA sells the chips, but those chips need massive amounts of power and cooling. CleanSpark provides the home for those chips. This is why you see terms like high-performance computing, or HPC, showing up in their earnings calls. It is a massive pivot. If you are using Fidelity ETFs or SoFi ETFs to get exposure to the AI supply chain, you are usually buying the chip makers or the software giants. But the infrastructure layer, the companies that own the power sockets, is arguably the bottleneck of the next decade. CleanSpark is betting the house, literally $1.15 billion worth of notes, that they can be that infrastructure layer. Future outlook is where the rubber meets the road. We are looking at a scenario where CleanSpark energizes nearly 300 megawatts of power in Texas by 2027. If they execute on this, and if Bitcoin stabilizes or resumes its upward trajectory, the current share price of $14.12 could look historically cheap. The catalyst to watch is the official signing of a major AI tenant. Rumors float, but a confirmed contract with a hyperscaler would instantly re-rate the stock. moving it from a mining multiple to a data center multiple, which is typically much higher. However, the risks are just as potent. If Bitcoin crashes below the cost of production, which is currently rising due to network difficulty, CleanSpark's cash flow from mining dries up, leaving them with debt payments and heavy infrastructure costs. Furthermore, if the government introduces stricter regulations on energy consumption, it could throttle their growth. This brings me to a question I want you to answer right now. Do you think the government will pass legislation in favor of the cannabis industry or the crypto mining industry anytime soon? It seems like an odd comparison, but both are highly regulated, energy-intensive in different ways, and subject to political winds. Comment below with your thoughts on which industry gets the green light first, or if you think the grid restrictions will get tighter for miners like CleanSpark. Let's return to